Hi, my name's Anna Serin, and I'm Director of Listings Development with the Canadian Securities Exchange. You're joining us here on Wednesday, May 18th, 2022. As part of VRIC, I am joined today by David Rosenberg. Thank you so much for joining me, David.
My pleasure, 100%.
For those of you that may not know, David Rosenberg is the founder and president of Rosenberg Research. And you can go to his website currently and get a 30-day free trial. So make sure you check it out. It's at www.rosenbergresearch.com. You can also email David directly. He's given us his personal email, which is drosenberg@rosenbergresearch.com. So, David, thank you for joining me. We're talking today, Wednesday, May 18th. It's not been the nicest day on the markets. So why don't we just start there? What's going on right now?
Right, well, the major averages hit their lows for the year, and the S&P 500, as we said, is down 18% from the early year peak. So approaching the classic, quotes, bear market, which is when you're down 20%. So we're almost there. And look, the stock market is the bellwether leading indicator of the economy. I know you have Wall Street economists and Bay Street economists talking about, how great the economy is, but they're just talking to you about how things are right now. The markets are telling you how things are going to be tomorrow, specifically 6 to 12 months down the road. And the markets right now, especially when you're taking a look at the internals of the stock market, and you're taking a look at the wide swath of economic sensitive sectors that actually are in bear markets, the retailing stocks, the home building stocks, the banks, consumer services. It's really quite incredible that you would have thought that with the reopening of the economy and all the news about how all the airlines are filled and restaurants, well, those stocks have been hammered as well. So it's telling you something about the economic outlook that isn't too constructive.
Okay, so this is something, and maybe you can touch on if this is something we go through every time we go through this, but you touched on something there. There seems to be a lot of resistance of admitting that this is potentially a bear market. Do you feel that way, or is that every time that we go through this?
Every single time.
Yeah.
Every single time. So, and the reality is that so far we're building up to a bear market. There is a bear market in the NASDAQ. There's a bear market on Russell 2000. There's a bear market in most of the stocks in the S&P 500. The reason why it's not in a classic bear market just yet is because energy stocks have done so well for obvious reasons. But also the sectors that you actually want to own in a recession, the areas that don't have a high degree of cyclical sensitivity like utilities and staples and healthcare have hung in reasonably well. But you have wide swaths, like I said before, of the stock market that actually are in a bear market right now. But there's always denial. People want to be happy. People want the stock market to go up. It's a good thing when the stock market goes up, but history knows that the stock market doesn't always go up. We know from history that there are recessions, there are expansions. Thankfully, recessions are short and expansions tend to be long and hopefully strong, but recessions are part and parcel of the economic fabric. And you have the market cycle, the economic cycle, and they're joined at the hip. And right now we're going on the other side of the mountain that we've been in the past couple of years. We stuffed in a whole lot of a bull market in equities. I mean, you look in the past 3 years up until the end of last year.
It's been incredible.
It doubled. It doubled. I think the last time that happened was heading into the peak of the dot-com boom back in early 2000. So we stuffed in a lot of capital appreciation in the equity market, and because of fiscal policy and the reopening, well, what do you know? COVID, as bad as it wasn't the Black Plague after all. So and then we had the reopening, the Fed rapidly expanding its balance sheet. We stuffed in a lot of growth and a lot of bull market in a short time span, and now it's payback time. And it's payback time when interest rates start to go up.
Okay, so you bring up interest rates. Sorry to interrupt you. Obviously there is a fairly clear path on what we need to do. This is a bit of a unique situation, though, with what's going on globally, wouldn't you say, as far as inflation trying to fight against that?
Yeah, I think that it's a fight that the central banks are going to win, but unfortunately at the cost of the economy. So, it'd be one thing if this was an inflation that was caused by booming demand. Excellent demographics. It's none of that, though. This is really not about demand. You could argue last year, because of all the fiscal stimulus, that there was a big demand push, but that's in the rearview mirror. this last leg, the reason why people, even like myself, got transitory wrong, whatever transitory means, I've never seen a timestamp and a definition, but the reality is that inflation is punishingly high, much higher than anybody would have thought. The central banks are saying enough is enough, but this is not the sort of inflation that they can really fight without generating the conditions for recession, because it all comes down to these recurring supply constraints, right? Like basically, like, do we know that Omicron was going to hit? That became a source of supply side inflation. For example, women's participation rates coming back into the labor market was stalled because of the Omicron, as an example, created more near-term wage pressure. That was inflationary. And the next thing you know, we got China. China is interesting, right? I mean, 85% vaccination rate, if you actually believe whatever that vaccine
I
was.
was going to say.
And next thing you know, they're locking down 400 million residents. I mean, think of that. And these are mostly port cities that are integral for the global supply chain. So that gets hammered.
Yeah.
And then Vladimir Putin decides it's a good thing to go invade Ukraine, and wars are inflationary. And then we have another set of supply side constraints. A lot of this inflation is supply side.
Yeah.
The Fed is very
Supply side inflation is something we're going to hear a lot more of. Don't you think?
Well, we already have. I
Yeah.
mean, this is the sort of inflation we have. I think that if you're going to ask me how the Fed bungled things, they should have stopped expanding their balance sheet last year. I mean, coming into a housing bubble, they shouldn't have been buying mortgage-backed securities and just adding more fuel to the fire. So I will say there's some blame for that. I think they did a poor job explaining what transitory is. What is transitory? What does transitory mean? Is it weeks, months, quarters? Most people in the financial markets today, I mean, long-term for today's investor is like lunch tomorrow. That's long-term.
Absolutely.
So they didn't educate what transitory means. Look, we had two enormous supply side shocks. We had a global pandemic that clearly is ongoing in China, even though we're behaving as though it doesn't exist anymore. And we have the first shooting war in Europe in 80 years. Last time we had this situation, sample size of one, was a century ago. We had World War I, followed by the Spanish flu. This time around, we had a global health crisis, followed by a war. Back then, we had a war followed by a health crisis that had global supply implications. Well, from 1915 to 1920, inflation averaged 15% per year. And we're freaking out over 8% inflation. It was 15% per year.
Wow.
And I don't know, but it was transitory. Could transitory in the overall scheme of things, could that be 4 or 5 years? Now, the reality is that after these supply shocks subsided by 1920, we had 10 years of either no inflation at all or deflation. 10 years, once those shocks subsided. F. Scott Fitzgerald publishes The Great Gatsby in 1925. There's no word about the great era of inflation in there. There's nothing in there about 5 years of inflation. And this was 5 years after the fact.
Yeah.
So I would say that in 5 years' time, we will be talking about something else. And I don't think we'll be talking about inflation. I think that inflation will fall on its own accord. It's just that the Fed and the Bank of Canada, now even the ECB is sounding more hawkish. It's being led by the Fed. They're not taking any chances, and they feel that their anti-inflation credibility that they took decades to build after the 1970s is at stake. For the Fed, this is their red badge of courage. And so will they sanction, they won't tell you this out loud, a recession to get inflation back down? And they want inflation to come back down a lot. A lot of people say, well, base effects are going to take inflation down. No. They're not going to be happy if inflation this time next year is at 6%. Remember, 2% is their target, and they want to get it down there as quickly as possible. Now, I think there's a lot of factors at play on the supply side in the United States primarily that are going to help that. You're seeing energy production's picking up, thankfully. Motor vehicle production, despite all the supply constraints, is picking up. Even domestic semiconductor output in the United States is picking up. The real kicker is that 30% of the consumer price index is residential rents. And now you're starting to see, and we saw it in the housing start numbers came out today, there is a boom in multifamily starts, units under construction. We're going to be hit with a deluge of rental supply. That's out of the market. But I've traced this through. Inflation is going to come down quite a bit. And the other kicker is, of course, the supercharged US dollar. This is why people talk about, oh, is it the 1970s all over again? Well, it's a completely different demographic base. We have an aging demographic, not that vibrant. It was much different in the 1970s when there was dramatic household formation. But more to the point, Nixon closed the gold window. for the 1970s, the US dollar was down 12%. That led to more import inflation, just aggravating the inflationary cycle. The US dollar is up 12% in the past year. There's going to be a lagged impact on import cost inflation. So I think inflation is going to come down on its own accord. But here's the thing. The Fed is saying, we're not taking any chances. And they feel they have a credibility problem. A perceived credibility problem. I think it's overstated, but they've already hiked 50 basis points. The Bank of Canada, and now they're talking 50 or 75. And I think that the stock market is actually telling you that the risks of recession are high and rising, and that's something that I think we have to contemplate. You know, that's the thing, is that the Fed operates its policies through the financial markets, right? That's what's most important. How does the Fed influence demand? And right now they want to get demand down. Well, getting demand down in a very inelastic supply curve globally, and a supply curve that's been shifting to the left for the reasons I cited before: the war in the Ukraine, China's very aggressive COVID-0 policy. They have to crush demand. That's the stock market's giving to you on a silver platter. They see what's happening. They got to crush demand to get inflation down. The question is, how far do they have to go? And this is the tricky thing, because if their goal is to get inflation from 8%, okay, down to 2%, and they operate through financial conditions, well, I can tell you, financial conditions is just a code for where's the stock market going.
Yeah.
And so it's we've done the work. Where is the S&P 500? What level? What is the holy grail? What's that level that gets the Fed to say, we're done? This is what is actually going to get unemployment up enough to curb the wage inflation, get demand and better balance with supply. What is that level on the S&P 500? That's all people want to know. It's all what my clients want to know. Okay, I've talked enough. What's the answer? 3,100.
Yeah.
Right. So we still have we're probably about halfway through this thing.
Halfway through.
Yeah.
So, okay, this might be a controversial question, but I mean, our interest rates have been so low for so long. I think the generation probably below me anyway has never really understood what a real interest rate scare is. Do you think there's an overreaction, to this increase in rates? It's been so unbelievably low. To me, it still seems somewhat reasonable that we can push it a little bit further.
Well, look, we had, under the same guy, Jay Powell, he came in guns a-blazing when he got appointed to head up the Fed back in January 2018.
Yeah.
And they were shrinking the balance sheet, and they raised rates 4 times that year. And the next thing you know, in the fourth quarter of 2018, the market's down almost 20%. It's one of these things where you said before, we didn't quite get to 20, and that's when you get the resistance. But what did the Fed do? Well, we got the famous Powell pivot, and then they started cutting interest rates in 2019.
Yeah.
That's ultimately, if you're asking what is the condition under which I want to get back in the equity market, it's when the Fed stops tightening policy and they start easing policy. And that probably is going to be next year's story. My message is stay patient. Be disciplined, stay patient. That day will come. Next year will be the rebirth, but there's a lot of work that has to be done along the way. Now, in terms of interest rates, look, we had a mini interest rate cycle. Actually, Janet Yellen started the ball rolling when they started raising rates from 0 in late 2015. Went from 0, got to 2.5%. Not a high rate. In fact, the lowest peak for the Fed funds rate, in modern history. But rates did back up 250 basis points, and then the credit markets and the economy and the stock market screamed uncle, and then Powell said, okay, I hear you screaming uncle, and we're done. Yeah. And so and it's going to be trickier this time because inflation wasn't 8% back then, and they weren't really battling their credibility. So we had a mini interest rate cycle. I'm not so sure that the Fed is going to end up going as much as what's priced in. I mean, you're taking a look at what the Fed's telling you they're going to do and what they end up doing could be 2 different things. But between what they say they're going to do on their balance sheet and what they're going to do on the Fed funds rate, the combined impact is basically more than 400 basis points, because you have to take in the balance sheet. Right. The last time we saw tightening of that magnitude by the Fed was back in the Volcker era. And what I find very interesting, just to tie this all back in together, was on March 3rd when Powell gave his semi-annual congressional testimony in a conversation back and forth with Senator Shelby from Alabama. He compares himself to Jay Powell, to Paul Volcker. So Jay Powell says, in quotes, not once but twice, that Paul Volcker was the greatest economic public servant of his era. Why? Why? Well, because he killed inflation. Yeah, how did he do that? Did he? I mean, it's like today's central bankers. They should learn how to grow wheat, drill for oil, okay, and build semiconductor facilities. And maybe Jay Powell should fly over and speak to Vladimir Putin about pulling out of Ukraine.
Yeah.
But the thing is that they operate through the demand side of the economy. Well, he's comparing himself to Volcker. Volcker is revered for killing inflation.
Yeah.
Even people that weren't alive back then remember Paul Volcker. There's like monuments and statues for Paul Volcker. Okay, but come on, is it that tough to kill inflation if you kill demand?
Yeah.
And that's what he does. That's what he did. He killed demand, and we had back-to-back recessions. And here you got Powell's there comparing himself to Volcker. Like, there's no such thing as a sure thing, but almost a sure thing that a recession is staring us in the face. Yeah. Almost a sure thing.
Absolutely. Okay, so based on all of that, what sectors would you say to pay attention to, or maybe to steer your your investment money to, and what would you stay away from right now?
Well, I would still. I don't think the recession is fully priced in, so I would stay away from the consumer cyclicals, the retailings, the home builders, I would say the industrials, the transports. So the economic sensitives I want to stay away from. I guess, like, where would you want to maintain some exposure and not get hurt? Well, utilities are trading at a huge multiple relative to the market, but they normally get expensive as you go into recession because people want to own utility stocks because they tend to be not recession proof, but tend to be very resilient. And utilities also have a decent yield. I'd say that consumer staples a good place to be because no matter what, you got kids, you still got to buy the diapers and you got to buy the soap and you got to buy food. Now maybe you'll scale down. You'll eat more chicken and maybe less veal, and you'll go out less to restaurants and eat more at home. So I would say that food producers, food retailers, drug retailers, they should be okay. And those are the classic necessities. You want to focus on buying things in the stock market that make sense to you as a household. I want to buy the stocks of the areas that sell or make what I'm going to buy in a recession. So you want to basically own the defensives, the staples group. I mentioned healthcare, utilities. I would say, pipelines, MLPs have very nice yields, plus a hard asset. That makes sense to me. I think gold will do well. I could see that, and you were asking off camera about Bitcoin. It's fascinating, but Bitcoin, I still don't understand why people think it's an asset class. I guess you could just invent an asset class. It is called cryptocurrency. No one ever said, let's take Swiss francs, sterling, the euro, the Japanese yen, and make an asset class out of these currencies. It's a means of payment, but people have turned it into, for low-income people, it's a get-rich-quick scheme, and then for the ultra-rich, just play money. Might as well go to the casino. What I'm saying is basically that everybody's always saying, well, it's digital gold. Well, I just say we'll just buy the gold. Gold is a true stabilizer in the portfolio. It is inversely correlated with bonds, inversely correlated with stocks. It is a true ballast in the portfolio. So if you're asking me, I like gold, and I think that what's going to happen, because you see Bitcoin is just another speculative trade. It's it's got an 82% correlation with the stock market. I mean, I would just say if you want that much risk in your life, forget Bitcoin, just buy the stock market. At least it gives you 1.5% yield. What is the cash flow stream that comes from Bitcoin? So, but I'd say that what's going to happen, I think, is that people are going to lose faith in Bitcoin as, quotes, an investment, and given its correlation with the stock market. So my view in the stock market tells me that Bitcoin and the like have tremendous downside. And I think that people were saying, well, you know what? This is a new sexy thing, and gold is old and boring. And so all the flows that went in, the investment flows that went out of gold in the past several years into crypto, those flows will come back into gold. Yeah. And so I see that the gold price is going to do well. I'll say one other thing is that, the US dollar trade might be the most overcrowded trade that there is. And what's going to happen, I think, is that what does the Fed have to see to back off? I think they got to see in the real economy cracks emerge in the labor market. By the way, if you dig deep enough, you can start to see some cracks emerging in the labor market. Small business employment is down more than 100,000 in the past 3 months. Small business employment, and I'm a small business owner, we have our eyes on the economy. We're not in some ivory tower at some big bank. We tend to move more quickly. And so that's a great turning point indicator. I'm noticing that firing rates are starting to go up, hiring rates are starting to come down, starting to see some funky stuff happening, beneath the veneer of the labor market. And if we start seeing the employment picture change, the Fed will have to be convinced, so it's not just 1 or 2 months. So I'm talking more probably the July, August time frame. If the unemployment rate, by the way, is up 3 or 4 tenths, the recession will be here. That is, and people say, what? I mean, you're talking about the unemployment rate's at 4% and we'd be in recession? Yes, that's what I'm saying, because it's not the level of the unemployment rate that matters, it's the change. We could be there, and so what's going to happen, you see, is if I'm right on this, a lot of the tightening expectations by the Fed, the rate hike expectations that have driven the US dollar up, is going to come out of the market. What does that mean? It means the US dollar is going to go down. That's another reason why I'm very bullish on gold, because gold is priced in US dollars. Gold, by the way, how it's been behaving in other currency terms, right? It's been, people, my own clients say, what's wrong with gold? What's wrong with gold? Why isn't it a new high? It's 1,800 and change. Say, well, it's a U.S. dollar story. If you took, and then if you look at the gold, what it's done in yen terms and sterling terms and euro terms, it's in a bona fide bull market, which is very encouraging, because it does mean this is just a U.S. dollar story, and this too shall pass. U.S. dollar, I think second half of the year is going to come under downward pressure, and I think that gold being priced in U.S. dollars is going to be a very good place to be. In addition to the fact that it is a ballast and a portfolio stabilizer, especially considering that at that point, it's not going to be clear that the bear market in equities is going to be over. Gold will hold its value.
Yeah. Do you think the smart money that has been investing in this cryptocurrency is going to take this opportunity to take their money off the table and move to gold? Do you think that transition will happen?
Yes, that's an assumption. That's just basically a commentary on human behavior. That the weak hands are going to get out of crypto. Okay, and so and that's it. Basically, it's just people don't realize that you're just buying a correlation with the stock market. And I was saying that all along. You're just buying, but like I said, if you're that bullish, just buy the stock market. At least it gives you at least, or do something with the stock market. I'd rather you just win about bank preferreds. And get a 5% plus yield. Than go into Bitcoin.
Well, and the stock market is made up of companies that have tangible assets, and they might have something behind that, whereas cryptocurrency is a community, right?
Look, I know how look. Gold doesn't have a cash flow stream. I mean, gold companies do, but I'm not talking about necessarily the mining stocks, but gold price. But it's been around a long time, and there's some real time-worn, established relationships, like gold's relationship with the U.S. dollar. Gold's relationship with real interest rates. Real interest rates go down, like I think they will. Real interest rates will go down once the Fed signals that it's done. This is the second half of the year story. Gold probably goes up to new all-time highs in that environment. Bitcoin is just, it's just a risk. It's a risk-on trade. It's correlated so you're really doubling up on your asset mix when you're laying around risk on top of risk. Not this part of the cycle. I think, I plan actually on turning much more constructive on the outlook for risk assets once we get past this part of the cycle. And that'll be next year's story. What's interesting is that I just had a debate on CNBC with a Wall Street economist, and this is it. This is what you do as a sell side economist. Is you. Yes, so he says there'll be a recession, but not till the second half of next year. Which I'm I'm perfectly hedged because I call for recession. But I actually think that by the second half of next year we're going to be in the rebirth. It's just the cycle. People get so I'm very passionate about what I do, but people get so emotional. But then again, we are talking about money. But you talk to people about a recession. I've been in the business since the mid 1980s, and I know you look somebody.
They don't want to talk about it.
They don't, because they want to be happy, and recessions don't make people happy. But look, if I wanted people, I want to help people make decisions. If I was in the business where I thought I had to make people happy, I would have called my company Rosenberg Circus instead of Rosenberg Research. So I want to help my clients make money and save money, and identify where are we in the cycle. You see, that's something else we have to consider. Is that people will say, don't worry so much. The market always does well when the Fed first starts hiking interest rates. And look, we hear this stuff all the. I mean, I don't think they're saying it that much anymore. Now they're on the precipice of a full-fledged bear market. But that was the mantra. Look, I get clients, who subscribe to other people that say, well, this is so-and-so said this. How do you respond? Yeah. Well, look, the reason why historically the market does okay in the first few rounds of the rate increases is because the Fed is usually tightening policy in the third inning. And now they've waited till the eighth inning. We have this indicator. It's got 17 different macro and market variables, and we look at how they perform through the cycle, their pattern of behavior to identify where are we in the cycle. Like we're basically about 85% of the way in the cycle. People say, but it's been only 2 years. Yeah, well, it was a short recession, and it's a short expansion. It's very much like the early 1980s.
Recessions can be quite short, right?
Recessions can be, but there's no get out of jail free card. People say, oh, it's a mild recession, therefore it'll be a mild bear market. No. Because I'll tell you that as bad as it was with the dot-coms who got carted out, the recession of 2001 was barely perceptible. GDP barely went down. And we still have the S&P in a 3-year period go down 60%. So the situation is, what they say, the higher they are, the harder they fall. And we went into this situation with valuations. Going into this year, the valuations in the stock market were only this high in the past century in the dot-com bubble bust. And so that's what happens in a bear market, right, is that you firstly the Fed starts raising rates and you get the valuation compression. And this whole 18% down on the S&P so far has just been the multiple coming down because the multiple is correlated with liquidity, and that's correlated with what? With Fed. We haven't even seen the earnings recession yet. That comes next.
We've started, haven't we? We've seen bits and pieces.
Target today, and Walmart. So it's starting. It's starting, and this comes down again to the inflation. It's very interesting that because this inflation, the cost push inflation, has been coming for about a year and a half now. And yet it was only until recently that profit margins were at an all-time high. Oh, these company, the CEOs and CFOs on their quarterly calls, belly aching about material costs and labor, blah, blah, blah. Meanwhile, the margins are at an all-time high. Gee, I wonder how that happened. And it's the only thing I actually agree with Joe Biden on is when he talked about the price gouging, because that is exactly what's been happening. Companies have taken advantage of this inflation psychology. Let me just tell you something personal, okay? That somebody close to my business gave me some advice and says, you know what, you should take advantage of this too and raise your prices. I said, well, that's not going to happen, okay? But that's the mentality.
You feel it as a consumer. You can tell.
And consumers are starting to change their behavior. For the first time, they're finally pushing back. But get this. This comes down to why I think inflation is going to MELT. Inflation is going to melt, and people don't believe it. They think we're in some sort of new era. This past year,
they always think that it's new.
The 70s was 10 years. We're one year into this. Okay, transitory didn't work, but the inflation mentality. But I think we'll be talking about something else 12 months from now. The corporate sector in the United States, in the past year, 1 year, put through 4 years of price increases. Never happened before.
Wow.
4 years of price increases in 1 year. So you have to ask yourself the question, after fattening up their margins like this, do you think, what's the inflation outlook for the next 4 years? Do you really think, and that was the thing about the 70s, was when they talk about the spiral, was companies were always trying to just preserve their margins. They fattened up their reserves on margins to such a degree. But they're not going to get the opportunity now. The Fed is going to be crushing demand. And people will not be able to, they'll trade down or they'll just postpone. And it's just the natural economic reaction to what's happened. But when you think about 4 years of price increases into one, there's going to be a payback for that. I'm going to tell you right now. Very interesting statistic, okay? Now, on the way out of the conference, we had this one person follow us and say, well, inflation expectations are driven bond yields up. And I said, no, actually, inflation expectations in the marketplace haven't really moved that much in the past couple of months. It's really been the real rate and the term premium as of getting fancy schmancy and bond yield determination, but it's really been about the Fed. It's about reset of Fed expectations. It's not really been about inflation expectations, because if it was, we'd be back at 1.6% as opposed to, say, 280, 290, and almost a week ago, 3% plus on the 10-year note. So, my sense is that inflation is going to come down, and there's people that are starting to think about deflation again. And when I talk about deflation, I mean, the looks I get. Well, they say, well, but oil's $100. I said, yeah, but where's
it's hard to imagine even talking about deflation right now.
If oil was $100 next year,
Yeah.
the inflation in oil, inflation is, it's like, so Volcker was the inflation dragon slayer, but, by the time he left, the Fed at the end of 1986, inflation wasn't zero, it was 4 or 5%. Now, it wasn't double digits, but inflation's a rate of change.
Yeah.
Very interesting is that we got the University of Michigan Consumer Sentiment Index for May last Friday. Venerable index, goes back to 1951. Do you know that in the survey, 14% of the respondents, 14%, it's doubled over the past year, 14% actually believe prices will deflate in the next 5 years.
Unreal.
And I say I want to find out who they are.
Yeah.
Because I'm going to hire them on my team.
David, I feel like we could talk for hours. I know that you have many more things to attend to today. I can't thank you enough for your insights. Would you please, next time you're in Vancouver, join me again and we can sit here and do more of this?
I would be more than happy to. Absolutely.
Thank you so much.
Let's just hope that the view changes by then.
Well, the view is always changing. I mean, it'll be interesting to see. You know what? I did want to ask you one last thing. This was one thing I wanted to check in on. We have, I would say, a new generation of investor that's come in, and they're learning as they go. And it takes these cycles to teach them, how to invest. And I think that there was perhaps some overvaluations going on almost everywhere that I looked. Do you think that this recession will probably help us a little bit kind of get things to a normal state that match fundamentals? Is this important to happen?
Yeah, well, that's what recessions do. And so people don't like to talk about them, but they're think of them as a purge. It's a cleansing.
Yeah.
And so, look, the good news is that the people that found the stock market too expensive, didn't invest, are going to have a great opportunity. Those people that right now have cash and liquidity, that have that reserve to put to work at better price levels in the next 6 months, it's going to be a cornucopia. I mean, a smorgasbord for these people. So, yeah, and I think that's what recessions do, is they basically knock sense into us because it's just the cycle. And at the peak, maximum greed. Yeah. And then at the bottom, maximum fear. And you want to have cash on hand when there's maximum fear, because maximum fear is when the weak hands in the market have to liquidate, right? Yeah. And so, and the same in the housing market. Like the housing market will follow the stock market. Housing market is as crazy, expensive, and vulnerable to interest rates as equities. And once again, look, if you're in Canada and you bought a home in the past couple of years and you leveraged up and you're in a short-term mortgage, well, my heart goes out to you. Be that as it may, we're going to go through a house.
People are very leveraged, I think.
Very leveraged. People say to me, Rosenberg, you've talked about this for quite a while. You're like the boy who cried wolf. To which I say, well, remember, the wolf shows up at the end of the story. Yeah. So I think that, look, so if you're a renter in Vancouver, we've been crowded out for so long. Yeah. And it's become a social problem. Well, the thing about a recession is it does create winners and losers, okay? Yeah. And the winners will be, as home prices correct, will be the people that have rented and been saving their money and waiting for the time to get in at much better, at much more affordable levels. And that's so. I'll tell you what. Talk about taking sour cream and turning it into ice cream. That we can make a recession sound like such a benevolent.
That's right. I like them both.
That's why they call economics a dismal science for a reason.
David, thank you again. Again, I just want to remind our viewers that you can go to his website and get a 30-day free trial. I will be starting mine as of today. Thank you again so much for joining us.
Pleasure.
And I look forward to chatting with you again soon.
Me too.
Thank you.